Well, ladies and gentlemen, the United States has crossed $40 trillion in national debt. And unfortunately, this happened on the same day that President Trump's secretary, Scott Bessent, the Treasury Secretary, announced that they're doubting the size of a program that's designed to support the long end of our bond market. Now, these are not two separate stories. Okay, the debt is no longer just some giant number that's sitting on a government website. Okay, it's not some number that's going on Thomas Massey's little ticker. Okay, the market that finances that debt is now demanding Washington's attention, and it's going to get it. So again, $40 trillion. Now, we were at $39 trillion in March. $38 trillion 5 months before that. And this didn't begin with Donald Trump, okay? Also didn't begin with Joe Biden. This is decades of Washington, D.C. spending more than it collects and borrowing the difference and also pushing it forward. But $40 trillion is where we are now. And the timing matters on this because the same week that this number crossed $40 trillion, okay, long-term Treasury yields are sitting near levels we have not seen in almost 2 decades. The 30-year Treasury yield hit about 5.34% on Tuesday. That was the highest level since 2007. And that matters far beyond Wall Street. Long-term Treasury yields feed directly into the cost of long-term borrowing across our economy. Mortgages, business financing, government interest expenses. When Washington has to pay more to borrow, we as regular Americans, we feel it, okay? And people are getting confused, and Washington benefits from this confusion, okay? The debt is the pile. The deficit is the annual hole, okay? Every year, the federal government, when it spends more than it takes in, it has to finance the gap, okay? Over time, the deficit builds into the national debt. And that doesn't always, make sense to people, okay? But the Treasury has to keep that machine funded. Now, on August 3rd, Scott Bessent said it expected to borrow $739 billion in a privately held net marketable debt during the July through September quarter. And then another $628 billion in the October through December quarter. That's not, actually, it's net marketable borrowing. Okay, it's not the same thing as total gross issuance, but it tells us the direction. Washington is still borrowing enormous amounts of money just to keep financing our government. Now, that goes back to Scott Bessent, okay? And it also goes to one more piece that matters before we get to, the buyback on this. That $40 trillion headline is gross federal debt. It includes debt held by the public and intragovernmental holdings. Okay, those are different buckets. Okay, debt held by the public is the position that's owned outside of the federal government, outside of its accounts, and it includes investors, banks, pension funds, the Federal Reserve, and also foreign holders. Okay, the intragovernmental debt is money that one part of the federal government owes to another federal account. I know it sounds confusing, but stay with me. Okay, so when somebody tells us that $40 billion mean America owes, $40 trillion is what America owes, well, and that we owe it to China, that's not true, okay? But look, we can't let that accounting distinction become an excuse for us here either. Okay, the public market still has to absorb an enormous amount of Treasury securities, and the Treasury itself is projecting hundreds of billions in additional net marketable borrowing quarter after quarter. And that is the market that Scott Bessent has to manage. Now, on the 19th, he announced that it would at least double its long-end liquidity in support of buybacks. The maximum had been $2 billion per operation. And beginning in September, on the 9th, Scott says that those operations will be at least $400 billion each for the next 10 to 20 year and 20 to 30 year sectors. That program runs through November 4th, when the Treasury says it will provide more information. Now, you may be saying, all right, that's a lot of jargon, JR. What does it mean? Well, it means the Treasury is going into the market and buying back older, long-dated government securities in order to improve liquidity in parts of the market where trading can become thin. And you have to remember how bonds work, okay? When investors demand less of a bond at its current price, the price falls and the yield rises. So if the Treasury buys a thin part of the market, that extra demand can support prices and then ease some of the pressure on yields. And that's the mechanism, okay? It's a market function tool. But what it does not mean is that Washington just found a way to pay down the national debt, or the debt, I should say. Okay, the Treasury itself says that its buybacks are not expected to significantly reduce privately held net marketable borrowing because new issuance will replace the securities being bought back. And look, that is somewhat of the entire point of the story here, okay? The Treasury can they can change the plumbing, okay? It can improve liquidity. It can try to smooth out stress in the bond market, but it can't trade its way out of a structural federal deficit. It has to be Congress. They control spending laws. They control the tax laws. That's where the structural math has to change. And that's why I think the $40 trillion headline is actually smaller than the real story. The real story is that the people managing America's debt are now having to react to a market that's changing more for a long-term money play, but Washington, D.C. keeps adding to that pile. So to be precise, debt is not the only thing that's pushing long-term yields higher right now. Inflation risk matters, energy prices matter, the war with Iran matters, Federal Reserve matters, massive corporate borrowing and AI, their infrastructure matters. But fiscal credibility is on that list too. And that's what makes this different from the normal debt clock argument. The bond market doesn't care about elected official talking points. It prices risk, inflation, supply, and whether investors believe they're being compensated for lending money for 10, 20, or 30 years. And on Wednesday, Scott Bessent's announcement, it worked for a minute because long-term yields fell, but the day after, much of that move had already been given back. So the 10-year yield was back around 4.69%, and 30-year was around, I think, 5.2. Now, that doesn't mean the Treasury's failed, okay? Not by any means. It just means a liquidity tool is being asked to operate inside of a much bigger fiscal and economic problem. So look, folks, if you want the political story behind the numbers instead of, just another dude on YouTube talking a bunch of crap for the algorithm, subscribe to the channel. Let me tell you, I'm not the first guy that understands how the Treasury works, but when I hear these types of stories, I'm looking into this. I'm looking into inflation, how these money markets move, what Scott Bessent can and can't do, what Congress needs to do, and the overall mechanism of how President Trump could direct the reduction in our national debt. So this isn't just something, that comes very easy. I'm learning just as much as you are, okay? And I appreciate you being here. But look, ultimately, this is where we have to have accountability coming first. Okay, for years, we've had both parties treating debt like something that only matters when the other side's in power. Republicans suddenly become accountants when Democrats are in power, and Democrats suddenly discover fiscal restraint when Republicans want to cut taxes. And then everybody gets back to Washington and the machine keeps spending. And that bullshit has a price. And the price is not just some theoretical number that our grandchildren might deal with someday. It's the interest bill that we're paying today. It's the mortgage rate today. It's the amount of federal revenue that gets consumed servicing old borrowing instead of paying for actual national priorities. And it was reported Thursday that interest payments that have been paid so far this year were already approaching $1.2 trillion. And that's not money, building a new warship. That's not money going to secure the border or fixing a bridge. It's the cost that Washington, D.C. has already made to finance their past decisions. Now, Scott Bessent says that President Trump's administration is preparing a new fiscal consolidation effort with the White House budget director, Russ Vought. Okay? And Russ is a sharp dude. And Scott says the administration believes that it can find some major savings through spending reductions and eliminating waste, fraud, and abuse. And we know that J.D. Vance is leading that task force. I think that's a good proactive step, and they should do it. But there's a part that Congress needs to hear, okay? The administration and Treasury can manage the financing. OMB can attack the waste. And the president can propose some cuts, but none of that removes Congress from the equation. House and Senate are still going to write new spending laws. They'll still write the tax laws. They'll still vote the bills if they're getting, if it's of their interest, unless it's about election integrity. They still own the long-term arithmetic here. And if they keep treating trillion-dollar deficits as normal, the market's eventually going to make their choices more expensive. And that's not some, ideology. It's just how borrowing money works. There are real challenges here. Those challenges come with three parts. Okay, first, Washington needs to get serious about the structural deficit. That means actual spending discipline, promotion of growth, and a tax system that raises the revenue that Congress has illegally chosen to require without strangling the economy. I prefer they don't touch the taxes, but that's their option. Second, Washington needs to, look, they keep betting that economic growth will outrun the problem. And that matters. We want the economy to be larger, but it can't make a given debt load more manageable. Well, it can actually, but it won't repeal arithmetic if they keep deficits at an enormous level year after year. And then third, look, Washington keeps borrowing, and they're doing so at a pace that, the bond market determines how expensive that becomes. And that's the path that none of us should want. Because once interest expenses start competing with defense, infrastructure, border security, and everything else that we want to get done, fiscal weakness becomes national weakness. And that's the America First concern that we should have. Because if this country cannot control its own balance sheet, eventually it will give other people leverage over our choices. And it's not because America is about to default on its money tomorrow. It's because every dollar that's committed to financing yesterday is a dollar that can't be freely deployed. And we are already talking about a federal debt number with 12 zeros after 40. Now, there's an upcoming checkpoint on September 9th. That's when the Treasury's larger long-end buybacks will take effect. Then November 4th, they're scheduled to give the market another update on the program. So between now and then, we can watch the yields, we can watch the borrowing estimates, watch the deficit, and watch Congress. Because Scott Bessent is totally capable of managing the market mechanics. President Trump can push a fiscal consolidation plan, but Congress has to recognize that they're the institution that ultimately has to change how they handle the structural math. So, Congress, what do you think? Are you going to finally treat this $40 trillion like a warning? Or are you going to keep asking the Treasury to manage the consequences of your actions? You own the math. And look, let's not leave much more than we have to for our grandkids to pick up, because it's getting kind of cumbersome, don't you think?